Nasdaq TradeTalks, where we meet the top thought leaders in digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have John Davi. He's CEO and CIO at Astoria, as well as Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Kevin Mahn, President and CIO of Hennion and Walsh, and Michael Normile, our U.S. economist at Nasdaq. And Michael, I'm going to kick it off with you. Quite the way to start the year with the jobs numbers. Economy appears to still be rolling along here.
Yeah, I mean, everything, a surprisingly great number, right? 256,000 jobs added, about 90,000 more than was expected. And the unemployment rate ticked down to 4.1%. It was expected to stay flat at 4.2%. So all around, very good jobs number. I do, personally wonder if maybe we're making too much out of one number. We might see, things normalize a little bit after this, and you do have the whole kind of trend of lower response rates that we've been seeing in the last few years that makes it more subject to revisions when we get that second and third print. But for now, the first print came out really, really strongly, and it looks like the U.S., ended 2024 with some nice momentum to the economy.
Yeah, and Michael, you've made that point before. If we go from 4.1% to 4.2%, that's kind of, a fluctuation you would expect. It's when we start to see the tenths move higher or lower that there's a trend shift, right?
Yeah, and we've been stuck in this range for a while now. We got up to 4.3% in the summer, and that's when there was all that concern about recession for a little bit. But we've come off that and just been stuck in the 4.1, 4.2 range for a while, which is actually, historically a really strong unemployment rate, very, very low by historical standards if you're going back the last 55 years, basically. So overall, the labor market looking pretty strong.
Yeah, and Kevin, I think the performance in 2024,
yeah.
I don't think anyone was expecting that, especially when we were thinking about 6 to 7 rate cuts going into the year, and fundamentally the market performed well, and your mantra's been pretty consistent, slowing but growing.
Yes.
That might be the economy, not the market from last year.
Absolutely, and I think these beginning stages of the new year, Jill, are a microcosm of what's likely to unfold across the entire year of 2025 for the markets. More short-term bouts of volatility, more uncertainty, some changes in market leadership, and ultimately more growth opportunities. But I'm nervous that investors are getting lulled into this period of complacency, expecting another double-digit type return. And here's why. Going back to 1950, there have been 9 times when the market has rallied by 20% or more in consecutive years. 2024 was the 10th time. Here's the good news. In 8 of those 9 times, the market was higher the following year. What's the bad news? The market was only higher by an average of 3.6%, not 20%. So investors are going to need to be a lot more selective in 2025 to find attractive growth opportunities.
I think, John, you might also have to reset your attitude towards the market in a way, right? I mean, look at the past 10 to 15 years of performance. Usually the market goes up and down, and that's kind of how we get our average returns. But just looking at the performance from even through COVID, right, the rebound that we had, and then through 2023 and 24, it's easy, not easy, but you could see why people get complacent.
Absolutely. Yeah, I think the biggest surprise for me is how strong the economy is and the length of this, kind of recovery. I mean, we did have a recession during COVID, but it lasted like a couple of months. So, as a portfolio manager, all I think about is, okay, where can I get, the highest return per unit of risk? And when I think about like these broad-based indices like SPY and Nasdaq, they are very concentrated, very top-heavy, and they're very expensive. So, I'm a value investor, right? And we're like, okay, where is there bargains out there? So we've got like a barbell in our portfolio where we like equally weight, we like mid-cap, let's say, and we like real asset. And then we're using like, short duration bonds to kind of hedge our equity risk. And then we're using some liquid alts to kind of soften the blow in case that there is this like bumpy economic recovery. So the one thing that you don't hear anyone talk about is left tail risk, is like what happens if there's like a 15% drawback in the S&P. Nobody's, all these year ahead reports are all super bullish. So we're saying, okay, let's take some chips off the table in these market cap weighted indices. Let's broaden out our exposure, but then let's look at like, downside protection.
There's also the demand for alts, to your point as well, so that you're not married to a traditional model, or you don't have that correlation risk, or trying to soften that correlation risk.
Exactly.
Yeah. So Max, you're talking to NASDAQ listed issuers all day long. Any trends that you can discern in terms of how they're thinking about the macro environment, how they're thinking of the consumer? What are the risks that they're thinking about?
I think everyone that I spoke is looking for what should we be worried about outside of the economy? Obviously, rates have been the number one factor for everything, essentially. The past year, tech has outperformed. But everybody's kind of, what is it that could trip us up? We talked about it plenty of times here, before last year, expecting 6 cuts. And if we told you, yeah, we're going from 6 cuts to 2, what do you think the market's going to do? Or 1 cut, what do you think the market's going to do? Do you think we're going to be up 23%, or do you think we're going to be down 10%? You probably would have said, hey, if we're taking out 4 or 5 cuts from what we're expecting, we probably think the market's going to go lower. So that was kind of one last year to watch. Hey, if we don't get these cuts, that might trip us up. We went right through it. So everybody's kind of interested to see what happens on the geopolitical landscape. Obviously, with the new administration coming in, there's a lot of ideas of what is going to happen, but to see it actually take place, from government spending to trade policies, reshoring everything, kind of bringing it back here, is that going to be an impact as much as people think it is, where it actually hits the bottom line, or is that going to just be kind of another blip when we go through it? And we also talk about kind of off the COVID lows. I think that's kind of, at least myself, speaking to people, the recovery we had kind of spooked people away from being on the sidelines and kind of allowing dips to happen. It's being bought, because the entire way back after the March 2020 lows, it was, no, we're going to retest. Everybody kind of sat there and waited, and then you got left behind.
Right.
So now we get these dips. It seems like everybody's buying and getting more involved, and we started to see something recently with equal weight getting a lot more traction. Started to see inflows into the equal weight ETFs to kind of broaden out and diversify a bit, because again, I mean, if you're looking at the sectors to start the year, last year obviously tech was the leader, communication services. Energy is up so far this year. Again, we're only 2 weeks in, but you're showing a real rebound in energy. Materials, which was the only sector that was lower last year, they're up a few percentage points this year. So we're starting to see a bit of a rotation. Hopefully that breadth continues. Small caps, again, it's one-day moves, but started to catch a bid here. Right. Hoping that kind of rates have topped out.
So, Kevin, it always goes back to what's your time frame as an investor and how you're approaching the market. A couple things here. What was in 2023? Like 95% of macro strategists expected a recession.
Yep.
It didn't play out. Inverted yield curve, and nothing happened with that. But you have to ask yourself, in November 2022, if we did not get AI, Gen AI, as part of the consumer vernacular, and everyone, rushing to have that story, every single story. We were just at CES last week, the Consumer Electronics Show. Every company was talking about their AI strategy. They're talking about ROI now too, which is interesting.
Yeah, the AI revolution is alive and well, and I think that's a theme that's going to continue not only in 2025, but in all likelihood for the next decade. But investors need to think about NI as more than just NVIDIA, more than just semiconductors and chips. Think about the more broader AI ecosystem. Think about the data centers. Think about the cooling solutions that are necessary for those data centers. Think about the immense power need that all of these data centers draw down on. And it's not just electricity, now it's including natural gas and nuclear. More opportunities with multi-utilities to supply that nuclear power. So I am very bullish on the outlook for AI-oriented investments down the road, but investors need to be patient, just as much as those companies that are devoting significant CapEx spending to this space need to be patient with their ROI on those investments.
So, John, let's go there for a moment, because you're talking about the barbell model and how you're looking at other sectors. When we were at CES, we were in what was the EV hall. Now it's the electronification of everything. When you think about auto tech innovation and safety innovation and so forth, John Deere, Caterpillar, autonomous fire engines. We had Corning, companies like that. Every vertical now has some component of being in tech, if you will.
Yeah, I mean, I think you need to look, beyond just the tech sector for sure.
Right.
So if you think about how much, the technology sector represents of these standard indices, it's so, it's so out. It's like 100-year wides, right? Goldman Sachs has this report that shows like how much the top 10 stocks make up of the S&P, and it's literally at 100-year wide. So, you have to broaden out your exposures. I mean, tech is still a big part of the earnings growth. It's supposed to deliver like 35% of the earnings growth next year in 2025. But, I like some of these other sectors. I think, between like the data centers like Kevin's talking about, the real asset sectors like energy, which are going to use AI to make their stuff, a lot more efficient. So, we run a fund, a real assets fund, PPI, that gives you exposure to like data centers, power play, infrastructure, REITs, energy, industrial materials. I mean, the exposure, we serve as an outsourced CIO. The amount of portfolios that we have where people just load it up on tech, and the exposure that they have in these sectors, like these real asset sectors, are just minuscule.
Right.
So I think it's time to kind of diversify. You know, you've been basically discouraged to be diversified the last 2-3 years, right?
Yep.
You only benefited by owning tech, you know, SPYs and Qs, and that's great. They were home run plays, but like in portfolio management, you are supposed to diversify your risk. And I think, you know, 2025 to 2026 is going to be about diversification.
And it's interesting. Let's look at this from a very existential perspective. Again, back to CES, when they showcase their first year is concept, second year is production, third year is, okay, now we're integrating it, right? That's where we are right now. So then you start to think, and this was a common theme there, access to these types of energies, data, and it's going to be a commodity. It's going to be ubiquitous. We're going to think of AI, agentic AI. Apps really won't be a thing anymore. Everything's going to revolve around this kind of technology. So when you start getting that utility, commodity conversation around it, that's when you have to start looking at other areas, because the story's been told, and now they're thinking from an operational fundamental perspective, what's the ROI? And you made the point about investing, you know, capital projects are expensive, especially in the energy and industrial space. However, the biggest allocators to R&D are Nasdaq 100 companies.
Yes.
Look at the growth
Yep.
in the past 10 years.
Yep.
That pays off.
Yeah. The bigger risk is not investing, because you will be
Right.
left behind.
Yeah, no, it certainly is. Michael, let's go back to the macro theme for a moment here. Anything that you're seeing in terms of the consumer? Any weaknesses, any trends that you can see, whether it's savings, spending, credit usage?
Yeah, I mean, we've talked about it before on the show, where it is a little bit of a two-speed economy for consumers, where you have the high-income consumer is doing really well, the low-income consumer is starting to struggle. People in the middle are doing okay, but on the low end, you know, they've been really squeezed by the fact that they spend more of their income on housing and energy and food and things that have seen the most inflation over the last few years. They've run through that pandemic era savings, so they're, you know, pretty much back where they were 5 years ago, or even maybe a little bit worse off. But people on the high end, they're still getting solid interest rates on their savings. Their house has gone up in value. Their equity portfolio has gone up in value. So they're still able to keep spending. And of course, people on the, you know, the top 20, 40%, they do the bulk of the spending anyway. So that's why we still see the consumer kind of chugging along at a pretty nice pace still.
Which is interesting, Max. We've discussed this before, where clearly you have to make the distinction between the market and the economy. Going to the election, going into December, people were negative on surveys in terms of how they perceive the economy. And the stock market, the S&P was up over 30%. So there is a disconnect in terms of how things are perceived.
Huge disconnect. As we talk about the inflation and even with wages, we're like, oh, wages are keeping up with inflation. You kind of look around and it's like, well, for who? I'm not seeing that. You know, you have conversations with friends, like who's seeing those things? And like you said, the kind of the top 20, 40% is really carrying that belt. So, okay, everything looks good there, but the lower end of the spectrum is not so much. So again, the spending and the investing, you have extra capital. All right, I'm going to invest because you see the market going up 20% a year. So you pour into it, so markets keep going higher. I mean, we're only, 21 times right now, but the markets keep going up. So those investors keep going. They're fulfilling that and gaining even more. So that dichotomy continues to diverge, essentially. That's why you kind of have that breakup. And like you said, the sentiment leading up to it ahead of the election, there's a real dichotomy of what people are feeling themselves as you go to the grocery store versus what the market is saying, and it's always used as a gauge. But like you said, there's a big dichotomy. Right. But even so, the market going up 20%, like you're saying, it was very concentrated in some of the mega cap names. You look at small caps. I feel like we've been talking about it
forever.
The last 2 years. Every show, it's been waiting. I've tried it myself. Time this thing. Okay, we're going to get the reversion. You see the spreads widening out, the outperformance of the large caps versus small caps. All right, now it's going to be the time. Now it's going to be the time. Rates are going to start coming in. Now's the time small caps are going to outperform.
It works for 2 days.
Good. It works for 2 days, and then it reverts back because everybody kind of goes back. Like you said, you're getting punished if you're not in those names. So it's harder and harder, but you keep waiting for these small caps to catch up, and it just hasn't happened. So even in the market, it's kind of like the economy. There's kind of two different classes. You see the one that's gangbusters, and everybody else is kind of being
So let's stick with that theme for a moment then, John. Are large cap U.S. stocks the Tina trade? There is no alternative?
I think there's a lot of alternatives. It's
Right.
more like what can investors, stomach, and how much risk are they going to take, right? Like, are they willing to kind of stand out? It's easy to hide in the Mag 7 stocks or in SPYs and Qs, but at the end of the day, you're supposed to, buy a stock where you think, here's intrinsic value. You want to buy it below intrinsic value, wait for it to achieve, par value, and then sell it. And I think there's a lot of opportunities, whether it's in the value sectors, small cap, mid cap, equal weight strategies.
Yeah.
I think small caps aren't going to work until you get, lower yield. So you probably need like a few rate cuts, but I don't think it's going to happen because of the economy and how strong, and you're articulating that. But some of these other value sectors, I mean, there's so many growth stories in the utility sectors that play into like the data centers and infrastructure plays. So you just have to look beyond just seven stocks and just not be myopic.
So, Kevin, on a remedial level here, when we're thinking about these Mag 7 or the concentration in the stocks, is it a function of portfolio management in a way? If you haven't owned them and your bench is the S&P or the Nasdaq 100, it's almost self-fulfilling, especially at the end of the year if you've under-owned them.
Yes.
So.
But you can't reinvest for what happened last year or over the last 2 years. You can only reinvest for today and the next year. So if I look at opportunities over the next year, I do think if there is a pickup in M&A activity, as I anticipate there will be, if interest rates continue to come down and if there are less regulatory hurdles with the new administration, well, who does that benefit? Small cap companies, such as small cap biotech, with large cap pharma continue to be put pressure on by Congress to lower their drug prices. How are they going to replace that lost revenue? They're going to turn to the small cap biotech companies and acquire them. How about regional banks, which are still trading at PEs of roughly 8, 9, 10? If interest rates continue to come down, treasury prices go up, their loan books expand, they become more attractive. So I do think small cap will start to come back in certain areas, but not all areas. And investors would be wise, once again, not to discount the benefits of diversification just because diversification hasn't worked over the last 2-year market rally.
All right, and we will leave that at a well-known adage on Wall Street. Appreciate everyone's insight, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.